Welcome. Today is Thursday, 9/8. This is the 8th of September. I'm Jeff Hughes, Chief Investment Officer at JWH Investment Partners and the founder of Alpha Insights. And this is your Daily Five. Daily Five is the show where we talk about the five most important charts that we're focused on. And I thought what I would do is take a few excerpts from our recent newsletter. And why don't we just start there? Because we've been getting a lot of email traffic from people who really are interested in signing up for our free investment newsletter. So let me just tell you a little bit about it. We just published the most recent edition online on the 3rd of September. And so this is kind of our big picture macro market view, if you will. You know, it's free to subscribe. Again, we deliver it to your email directly around the first Saturday of each month, affectionately called Huge Insights, the Big Picture. And, what we try and do here is just kind of lay out an economic backdrop and make a market forecast so that we're giving our readers some type of a roadmap to follow, right? But a lot of our readers want more. We get lots of emails, how do we invest, Jeff? This is a great insight, but give us some ideas. So, we've created this optional member level for those who do want a little bit more. It's $10 a month. Members actually receive one of our institutional publications called Alpha Insights, the Idea Generator Lab publication. And that details our top actionable trade idea each week. So, think about subscribing. If you need to access it, you can go to our website at jwhinvestment.com. And just click on newsletter, and you can read the most recent edition and subscribe. The picture that you're looking at right now is what you'll see when you click on that. It's also available on Twitter at @alpha_insights is how you find us there. With that, let's jump into the commentary here on chart number one. Taken right from our newsletter, we're talking a little bit about the market cycle here, and no doubt, at least no doubt in our mind, the peak of the blow-off phase of the market is definitely behind us. I mean, you can look at meme stocks, crypto, EVs, ARK, disruptive IPOs, SPACs. I mean, the list goes on and on, right? There's no question that the new paradigm phase was achieved probably sometime in early to mid 2021, and the market began to peak in various capacities back around really February of 2021 and right up until January 4th of this year. And we think that the decline from the January 4th high into the June lows really lacked any of the historically recognizable features of capitulation, let alone despair. And so in our opinion, from this cycle perspective, we think that the market has only really experienced a period of denial leading into the June low. And then the deeply oversold short-term breadth statistics led investors back into a bull trap. We saw a nice bull market rally, almost 19%, which topped out on August 16th. And by that time, in our view, we reached the return to normal point in the cycle where people think, hey, everything's fine, we're off to the races again, but the market has since rolled over hard down. But we've identified a spot here in this hypothetical cycle or theoretical cycle, if you will, where we mark you are here. And we're saying, we're right above this level where the market's wrestling with whether or not it wants to make a lower low. And we think the fear phase of the cycle will overcome investors once the S&P 500 makes a lower low. So let's take a closer look at where we are in the S&P itself. Like I said, the market has turned hard down. You might recall that when we hosted your Daily Five back on August 11th, we entitled that episode, Time to Move to Cash. Well, the S&P topped 3 trading sessions later. We were a little bit early, but only by less than 100 handles on the S&P for sure. And the market has turned hard down. It's plunged 10% over the next 14 sessions since that August 16th high. And that retraced about 61.8% of the bear market rally from the June low to the August high. Now, the bullish retest crowd knows that that's a very important level, the line of demarcation, if you will, right at around 3,900. And once we break that level, the odds begin to shift dramatically in favor of a lower low. And once the market makes that lower low, that's when the fear will begin to just overwhelm market participants. Now, let's take a look at chart number 3. And what we see happening in the VIX index is that, a volatility spike appears to be setting up. Fear is what's been missing from this market. From the entire bear market decline from the January high, there's really been no real sense of fear. The VIX hasn't posted a reading above 40% in more than 2 years. And, we suspect that in the not too distant future, that's going to change. There are 2 indicators that suggest this outcome to us. Number one, the VIX is now trading above the 24% level. And that's kind of acted as a boiling point for volatility in the past. The second one is that the VIX has begun to trend above its 21-day moving average. And that has historically preceded past spikes in the VIX. And so, we've also highlighted in the past that we've got this positive divergence from the VVIX, and that remains intact as well. So if we're right about this VIX spike that we expect to occur in the next several weeks, then we think it's most likely to occur as the S&P makes a lower low. And that could actually happen in days rather than weeks. So let's take a look at slide number 4 to get a sense of where we are in this entire, juxtapositioning of the market versus the VIX. Well, I showed a chart of the Dow Jones 1987 crash last time I did the show. I think it was August 25th. And, it showed that the Dow Jones collapsed by 41.2% over 55 calendar days from August 25th, 1987 to October 19th, 1987. So I'm asking this question, is this a 1987 redux? Are we going to relive that experience? And, we view the technical setup today as being very similar to that of 87, but at a much larger degree of trend. So while we're not forecasting a crash, we also can't rule it out. But we wanted to take a look at where we would go if, in fact, we were to see that sort of catastrophic change. And, if we just look at an S&P decline of 41.2%, that same degree of decline off the January 4th high, it would carry the index to approximately 2850. But if that said decline was measured from the August 16th high, much the way the Dow collapsed from the August 25th high in 87, it would count down to around 2550. We think that we're in the early innings of a third wave decline of at least primary degree of trend. If we're correct, then the decline should be epic. Let's take a look at chart number 5 to get a sense of how we can look at this and put it all in perspective. We've done some detailed long-term Elliott Wave Analysis. These charts look at our preferred count and our alternate count of the 13-year advance off the 2009 low to the January 4th high and the subsequent decline, right? And so we've been considering 2 plausible scenarios here. The first one is the S&P makes a lower low. The second one is the S&P does not make a lower low. So scenario 1 is our preferred count. It's not because we want this to happen. It's because the probabilities favor this in our view. And that preferred count assumes that the January high was actually end of cycle wave 5 of super cycle wave 3. If that view is correct, then the June low counts best as primary 1 down of a 5-wave motive wave decline, which should be cycle wave A of a 3-wave super cycle degree correction. Now, the rally that we saw to the August 16th high under that rubric counts best as wave 2, which means that we are in the very early sort of subdivisions of primary wave 3 of cycle wave A down right now. If that's operative, then this count looks like it's going to carry the market substantially lower, even further than the targets that I laid out. Scenario 2 is our alternate count, and that assumes that the market makes a higher high from the August 16th high. It only really comes into play if the S&P exceeds that August high, and then we would have to assume that, well, cycle wave 5 is probably still in progress. And so if that's the case, then we have to think that, well, primary wave 5 of cycle wave 5 is still in progress. And so this must be, intermediate wave 4, that the January high was only intermediate wave 3. And we'll probably see some sort of a lateral consolidation, most likely a symmetrical triangle, which could take many months to unfold. And so we would assume that we're in part of a B wave of this 5-point corrective triangle process, A, B, C, D, E. And so that B wave would probably carry to something, north of 4,600, but well shy of 4,800. And then it would retrace most of that wave B advance. And what we would then be looking for is a breakdown to a new low or not. And if it fails to break down again, then we'll know that we're in a lateral consolidation of the triangle variety. If it does break down from there, then we'll know that wave 2 just was more complex and carried much higher than we initially expected. And so that's the alternate count. But again, that scenario only comes into play if the S&P takes out the August 16th high. Right now, I think it's best to assume that the market is at the precipice of a third wave decline of significant potential. And that potential could carry the market down into that 2850 to 2550 range. We've kind of assumed around 2750, which is the 50% retracement of that 13-year advance off the 2009 low. It's kind of a good wave 3 low target area. And we think that could occur by October 25th to November 8th, election day. We think that window, which lines up very well with Paul McCray Montgomery's major cycle turn dates for the season. And that's kind of a working hypothesis right now. We really lay out the details of all of this in the newsletter. So I encourage you to subscribe, take a look at it. You can find it on our website. And with that, let me just close by thanking you very much for listening to us. And if you'd like to follow up and take a look at our work in greater detail, again, go to our website, jwhinvestment.com, or follow us on Twitter at alpha_insights, or you can just shoot me an email, jhuge@jwhinvestment.com. Would love to get your feedback on this video and share our insights. With that, again, thanks for watching.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.